So the third factor focuses on concerns that the tax and spending bill could increase the federal deficit. How are the markets reacting? And what are the long term implications?
Right. So that tax bill is, I'll timestamp us again. We're July 1st. It's moving through Congress right now, kind of a developing story. But zooming out a little bit, concerns about the deficit in the US are nothing new. Worries about kind of unsustainable levels of debt pop up pretty frequently on Wall Street. But this bill specifically is sparking a conversation that's a little bit more intense than it usually is. The concern among investors is that the path of policy right now, which is like tax cuts, spending, and trade protectionism through tariffs, will put strain on the bond market at a time where global investors might already be losing their appetite a little bit for US debt and kind of diversifying internationally. And what that would mean is higher yields over the long term. And we already saw this happen a little bit in May when yields on the 30-year Treasury spiked as this conversation was kind of reaching a more intense point. So higher yields mean higher interest costs for the U.S. government, which affects the fiscal picture, and then they also trickle down through the bond market to the stock market, where they can eat away at future earnings for investors. And then higher yields also reach consumers too in the form of higher borrowing costs, which is maybe most visible for people in the mortgage market.